One analyst warns that gold prices are fake and could face a tenfold overnight revaluation.
Analyst Adrian joins us with 3 other experts to break down these massive market shifts.
We have distilled their warnings on the yen, oil, and AI into this quick summary.
See why a specific pivot at 43.30 determines the immediate fate of your portfolio.
Matt DeWolf and the Trade Brigade are tracking a market that feels like it's holding its breath.
It's that classic pre-data drift. We have CPI coming on Thursday and PPI on Friday, so nobody wants to be the hero right now.
And that's on top of the war news in the Middle East? It's a lot for one morning.
The big picture here is that the market is stuck. We're seeing some relief rallies, but the overhead resistance is real.
Exactly. The S&P 500 is basically oscillating. Matt's looking for the market to either hold 4,300 or break toward that Friday low of 4,330.
So if it breaks 43.30, we're in trouble?
It wouldn't be pretty. It's all about whether the buyers show up before the inflation numbers drop.
Let's talk about the elephant in the room, oil. It's pushing toward $85 a barrel.
The Middle East conflict is the obvious driver here. If we see a breakout above 85.40, we could be looking at $90 very quickly.
Wait, if oil keeps going up, doesn't that just make the inflation data we're waiting for even worse?
Precisely. It's a double whammy for the Fed.
Oh, the tech side isn't looking great either, specifically the memory space.
Samsung reported an operating profit of 2.4 trillion won, which sounds like a lot, but it's actually a huge miss compared to last year.
Is that why Micron is capping down this morning?
Yeah, Micron is feeling the sympathy pain. When the giant of the industry stumbles, everyone else in memory gets hit.
Google is also in the crosshairs with these DOJ headlines.
The Department of Justice is looking at a potential breakup. They're targeting the search dominance and the Chrome browser.
A total breakup? Is that even possible?
It's a long legal road, but the market hates the uncertainty. It's another weight on the tech indices.
Matt expects the real fireworks to start Thursday morning.
CPI is the big one. If it comes in hot, we could see those 4,300 levels on the S&P disappear in a heartbeat.
And if it's lower than expected? Then we might finally see that short squeeze rally everyone's been waiting for.
On the individual stock front, keep an eye on Nvidia. It's hovering around some key levels.
Is it still the leader of the pack?
It's trying, but it needs to stay above 120 to 125. If it loses that, the whole AI trade might need a breather.
The plan for now is simple. Watch that 43.30 level on the S&P 500.
Right. Treat it as a pivot. If we're above it, the bulls have a chance. Below it, and we're looking at more downside.
So, basically, don't go all in before the weekend?
Exactly. Between the Middle East and 2 days of inflation data, being cash-heavy or defensive is a valid move.
Let the data settle first. We'll have a much clearer picture by the time the market opens on Friday.
Lynette Zang is back with a massive warning. That gold price you see on your phone or TV, it's not the real price of the metal.
She's basically saying the spot price is a fake number used by central banks to hide how much the dollar is actually losing its value.
Wait, so when I see gold is up or down, that's not what I'd pay at a coin shop?
Exactly. She argues the real value is hidden because the physical market and the paper market have completely diverged.
The core of her argument is the sheer volume of paper gold. For every 1 ounce of physical gold in a vault, there are hundreds of paper claims on that same ounce.
It's a massive leverage game played on the COMEX and LBMA to keep the price suppressed.
So, if everyone actually asked for their gold at once, the system would just break?
That's exactly her point. It's a game of musical chairs where there's only one chair for every 100 people.
Lynette points to the big players, JP Morgan, HSBC, and ICBC Standard, as the ones who actually set the tone in London.
They control the physical flow, but they trade in massive paper volumes that can move the price in seconds without a single bar changing hands.
So, the big four basically decide what my portfolio is worth today?
According to Lynette, they manage the price to ensure the illusion of a stable dollar remains intact.
The big takeaway here is counterparty risk. If you have gold in an ETF, you have a contract with a bank. If you have a bar in your hand, you have an asset.
So, if you don't hold it, you don't own it? Isn't just a catchphrase?
For her, it's the difference between being inside the blast zone or outside it when the currency reset happens.
She also highlighted the debt levels. We're at a point where the interest on the debt is swallowing the economy.
When debt grows faster than the economy can keep up, history shows the currency eventually gets sacrificed to pay it off.
And I'm guessing gold is the lifeboat in that scenario?
That's her plan B, using gold to bridge the gap between the old system and whatever comes next.
Lynette is predicting an overnight revaluation. One morning you wake up, the banks are closed, and gold is suddenly 10 times higher to back a new currency.
Wait, 10 times? That sounds like a movie plot.
She says it's happened before in other countries. The government uses gold to reset their balance sheet once the debt is unpayable. She's also sounding the alarm on CBDCs. She thinks they're the ultimate tool for negative interest rates and tracking every cent you spend.
The goal is to move everyone into a digital system, where the exit, physical cash, doesn't exist anymore.
So they could just tell me I can't buy something? Or tax me instantly?
Precisely. That's why she's so big on having assets outside that digital net.
Her final advice isn't just about big bars. She's talking about utility gold, fractional coins and silver you can actually use if the system glitches.
It's about being your own central bank. Diversify your holdings so you're not 100% dependent on a digital bank account.
So buy gold and hide in a bunker?
Not exactly. She actually emphasizes community. You need people you trust and resources like food and water, not just a pile of coins.
Gold is the wealth insurance, but your community is the actual survival plan.
Jeff Snider is looking at why the yen keeps getting crushed, and it is not what you hear in the mainstream.
Right. It is not just New York hedge funds. The real issue is domestic money, like pension funds and insurance companies, finding better returns outside of Japan.
So the money is leaving from inside Japan's own financial system?
Exactly. Japan even spent roughly $75 billion in official reserves recently and got almost nothing for it because they are treating the symptom, not the disease.
Jeff's main thesis is that higher rates from the Bank of Japan actually make the yen weaker.
That sounds the opposite of what usually happens.
It is because the hikes make the JGB market unstable, which gives Japanese institutions even more reason to move their money overseas. Steve notes that while large companies might be okay, small and mid-sized firms are getting crushed because the volatility blows through their hedges.
And they cannot just get dollars as easily as the big guys?
Exactly. It is causing real economic damage that the central bank seems to be ignoring.
They have done 27 or 28 rounds of QE, and yet the economy stays a mess decade after decade.
Jeff calls it the Einstein definition of insanity, doing the same thing over and over and expecting different results.
We saw this in August 2024, when money stopped flowing out of Japan because of risks in the US labor market.
That is the only time the yen skyrocketed recently, but it was not because the government fixed anything.
Jeff predicts that the yen will keep sliding because there is no perceived opportunity in Japan.
Until they figure out how to grow the economy again, everyone in Japan will be chasing returns elsewhere. Steve expects inflation to come down in the next 2 or 3 months because demand is weakening globally.
So the central banker's fear of rising inflation might be misplaced?
He thinks so. Wages are not keeping pace, so businesses cannot keep raising prices forever.
The key takeaway is that Japan needs to make itself more attractive to investors, but the government has no clue how to do that.
It is about creating opportunity. Until the risk-adjusted returns look better at home, the carry trade will continue.
Adrian Day is joining us to talk about why he thinks we're in a perfect setup for a strong move in the gold market.
He notes that prices and valuations are down while sentiment is weak, which historically leads to big gains.
Is he seeing a lot of concern among investors at the symposium right now?
He says sentiment is bullish, but realistic, despite the recent pullbacks from 5,000.
Adrian points out that 80% of investors expected rate cuts in January, but by April, 80% were looking for hikes.
This shift was driven by higher CPI and strong jobs reports, which impacted the gold price directly.
So the market sentiment just flipped entirely in a matter of months?
Exactly. And Day believes the gold price has already reflected this massive swing in expectations.
The mining space is extraordinarily weak. One day recently, there were actually 0 bulls in the sentiment sample.
Valuations are in the lowest 20 percentile historically, which is why he is buying more for his newer clients. COPX.
Why are generalist investors staying away if the value is that good?
They are still chasing momentum in other sectors, but Day thinks that changes once these miners show massive cash flow.
Central banks have been the main drivers of gold for the last 3 years because they want an asset that is no one else's liability.
This move picked up after the confiscation of Russian assets. Gold in a vault in Moscow is safe from foreign touch.
So they are returning to gold as a primary reserve asset?
Yes, just like they did back in the 60s and 70s, before the dollar's total dominance.
Adrian is very concerned about private credit because companies mark their own loans at 100 cents on the dollar.
He also notes that many companies building AI data centers do not even have a plan to make money from them.
Is there a resource shortage concern for these data centers as well?
Definitely. He mentioned that we simply do not have the energy, silver, or copper to supply all projected centers. Day predicts that the CPI numbers for July and August will be weak as lower oil prices finally reach the gas pump.
Combined with downwardly revised jobs numbers, he expects the hawkish pressure on the Fed will start to fade.
Does he think the economy can avoid a recession in this scenario?
He says the economy is more resilient than he thought, though a massive oil spike to 150 could still trigger one.
Over the next few years, Adrian sees the potential for a significant revaluation in the price of gold.
If the dollar starts to fall against other fiat currencies, that will be a huge tailwind for the metal.
So it's not just about inflation, but the systemic role of gold?
Exactly. Talk about gold's role in the monetary system would be a hugely significant and unexpected boost.
The final takeaway is to focus on management. Adrian would take a good team with no money over a bad team with a great project.
He has moved some clients to a 35% gold allocation and is buying more for those who are underinvested.
So the goal is to be positioned before the sentiment finally shifts back to gold?
That is the plan. When sentiment is this low, the setup for a move is often at its best.
And that's the full rundown for today. Want the final verdict, where these experts agree and where they clash head-to-head? It's in the video linked below.
Give this a like if it saved you time, and subscribe so you don't miss tomorrow's breakdown.